Many federal employees are unaware they may have higher Medicare costs into retirement, but there are things that you can do today to prepare for those higher costs. In this episode, we're going to cover the 5 most common healthcare options once you hit 65, explain why those Medicare costs may be higher, and provide solutions of how you can reduce your premium costs. Welcome. I'm Ed Smith, President of Valor Wealth Partners, where we're dedicated to educating federal employees on your complex and often underutilized benefits. In this episode, we really want to talk about Medicare and what the impact of the higher premiums might be to you. But first, you have to get a really good understanding of what Medicare is. We have a whole series on Medicare. It was the first time I actually was able to understand it, so we put this together in this presentation so you can be able to look at it. Please check out these 4 videos because they might help you out. But if you want to get just the answers about the premium cost and why they have a bigger impact on federal employees, let's first start looking at the types of healthcare options that you have. Now, there's 5 basic ones, and there's a couple others that we'll go over in a little bit more, but let's look at the 5 basic ones that we want to be able to look at. First is just continuing your FEHB. Now, the FEHB is a great program. They have 72% of your premium, both while you're working and in retirement, is covered by the federal government. So that makes it a great option for you. It's also very comfortable. You've been using this for years. There's also approximately 275 different options that you have, so if your healthcare needs change in the future, you might be able to shift to a different plan that might be more beneficial for you. And most people don't have that kind of flexibility to be able to do it, so it's a huge option to be able to do it. But there are some negatives for just using the FEHB, and we'll get to that in the future. The next option is looking at Medicare only and not having that FEHB. So dropping your FEHB and just going on the Medicare plans. Now, there's a couple of different options that you have, and it does get confusing. So like I said, those videos will help clarify some of those different areas. But when you're looking at Medicare, it's both private and government insurance. It's not just government insurance, it is both government and private. And most people need supplements to get even close to what FEHB is providing people today. So it doesn't always have all of the benefits that you like. One of the things that most people don't understand about Medicare is it's income-based for some of the segments. Like Part B and Part D, the higher you make for income, the more it's going to cost you on a monthly basis. And income could be a wide variety of things. It's not just the amount that is coming in, but it could be distributions from like traditional IRAs or your TSP. What it's called is IRMA, Income-Related Monthly Adjustment Amount. And you'll see IRMA quite frequently, and this is one of the downsides with using just Medicare, is because the premiums might be higher for you in most situations. We'll get back to this one in a little bit. The next option is a combination between FEHB and Medicare. Now, when you're looking at doing this, this might get the best of both worlds because the FEHB is your supplement. So you don't have to get a wide variety of those supplements that are out there in this very confusing marketplace because you already have the FEHB. So it's a combination of the programs you already know with the backing of Medicare that can be very beneficial for you. You do have some of that IRMA there, the income-related monthly adjustment amount, but you can reduce your FEHB maybe to a less expensive plan because now you have different options and you have different ways to be able to look at it. And remember, the government is still paying 72% of your premiums on the FEHB. Not on the Medicare, but at least on the FEHB, that is something that happened. Another option that we see very common with a lot of our clients is TRICARE and Medicare. Now, if you have TRICARE, you are required to have Medicare. So that is one of the things that there's no separate, that you can have only TRICARE. You have to have both TRICARE and Medicare. TRICARE is for certain members of the military and their family. So not everybody that was in the military qualifies for it, but most people that are retired or maybe they have a disability, they might be qualifying for TRICARE, but they would also have to have Medicare. Now, TRICARE and Medicare is the best option that you could possibly have to fill any of the gaps with Medicare where you don't need any supplements, meaning almost every copay is covered. So TRICARE and Medicare is the best solution I've seen. But again, you have to have served in the military or be a family member to be able to achieve this benefit. The last area is spousal coverage. Sometimes we see a spouse's coverage is so incredible it blows away FEHB. And you might want to continue that long into the future. It might even be able to that you don't need to have Medicare. But again, you really have to look at the benefits because some of those are just for your spouse. Some of them are for a period of time. Maybe sometimes when your spouse passes away, those benefits end, and if you didn't have a plan before, that could really hurt you. Now, there's a couple of other options that aren't in those top 5 options, like if you're on VA disability and you have VA benefits, maybe you're going to continue working, you might be able to use some of those instead of going on Medicare or FEHB, but those are the 5 most common ones that we see, is FEHB, Medicare, FEHB and Medicare, TRICARE and Medicare, and then spousal coverage. Let's move on to why federal employees may have higher Medicare costs. So this is looking at either the Medicare option or the Medicare and FEHB options that are there. Obviously, if you just have FEHB, this doesn't apply to you. It would also apply for TRICARE and Medicare because this does affect you on that side as well. So when you're looking at a federal employee, they have some really great benefits, one of them being the pension. And with the pension, it means you have a higher income base. So depending on if you're CSRS or FERS, a FERS would have the pension and Social Security, and the CSRS would just have that and would not generally have Social Security benefit. But this base of income, while it's really good, it increases that income, and it means that you might have higher costs. Now, when you add this in addition to your other benefits like your TSP and the required minimum distributions at age 72, that you're forced to take money out of your TSP or traditional components, if you have them, that could push it up even higher. This is even worse if you're both federal employees or a couple of federal employees because then you have 2 pensions, 2 Social Security checks, so that income base is very high. In this example, we're able to look at what that is for Social Security and pensions. Now, when we're looking at this example, we're looking at the green being Social Security, 2 Social Security checks, 2 pension checks. On the left-hand side, we have the marginal tax brackets, and on the right-hand side, we're looking at that IRMA rule that I talked about before. And as you can see, that as a federal employee, it's getting pretty high just with the income, even before we've started taking money out of your TSP. For this example, we used a GS13 Step 5 in DC at age 72 because we want to look at what the effects of required minimum distributions are. Now, with this federal couple, because they both have the Social Security and both have their pensions, they're right at that IRMA rules or that income-based level for the Medicare Part B. That means they are just about to have $170 a month per person. That's $340 per month for the couple, and it's over $4,000 for the year, just because your income is so good. And this is before you've even started to tap into the TSP with the required minimum distributions that are going to be coming in that year. So it is very critical to know what's going on and how this affects your medical costs going into the future. So now that we've seen the problem, let's look at some of the solutions you possibly can do. Well, the first thing is don't get Medicare. If you don't get Medicare, you don't have to worry about this income level. So if you're going to be at a very high income level, you might really want to see, is Medicare beneficial for you or the cost way too high? And you might select FEHB only. But remember that you might be leaving yourself open to higher medical bills if they are very high in the future because of the percent you might have to pay. So you really have to be able to look at what your need is, but also looking at what the income solution is. Another option is that you can give your required minimum distributions to charity. If you give them to charity in a special way, you might have it so you don't have to pay any extra tax or have that IRMA rules because it wouldn't count. Now, you can't do anything about the pension and Social Security. You've earned it, and obviously you want to get it. So we can't reduce that. But what we can do is change the withdrawals from your TSP or a traditional IRA. And when I say TSP, I'm just talking about the traditional side of the TSP. And how you do this is you take the withdrawals earlier, before age 65. You might have to go into 65, 66, or 67, so you might have a couple of years that you have to do this into the Medicare years, and you will have high costs those years, but at least it won't be for your lifelong. If you can start doing this at retirement or even at 59 and a half, when you have access to your TSP and pull it out, it could be very beneficial because you're planning ahead of time for when it is. You were controlling when the distributions come out of your TSP versus the TSP forcing you to pay taxes that could be higher and higher Medicare costs. Now, when you're doing this, you have to be very careful because there's a lot of different things you have to look at. One of them is taxes. You have to know where your tax level is, and the next marginal bracket, that could be a very big jump of how much more taxes you're going to have. So you definitely want to watch that. You also want to be looking at other factors of the timing of other types of things that might come out. You can take that distribution and you can do a couple of different things. One of them, you could do a Roth conversion, and we talk a lot about them. But taking the money out does not have to go into a Roth. You could put it into a non-retirement type of account, which just gives you more reserves or more flexibility. Maybe you need that money for something else that you're looking to buy. Another thing that you could take that money out to is just go out and enjoy it. Start spending this money early. Don't wait until 72 when you're having these required minimum distributions. You can start spending that money early in retirement and enjoy your life in a lot more fashion. Now, if we go back to that example we used before, one of the things you want to be able to do is look at the timing for Social Security. If you delay Social Security for a couple years, you might have a little bit more capacity to be able to take that money out. And when I say more capacity, in this example, there's $54,000 of Social Security coming out or going to you. If you don't take Social Security, that's $54,000 more that you can take out of your traditional IRA or TSP and not have it going into another tax bracket. So it just gives you a little bit more flexibility of how much you can take out of the TSP without paying more taxes. There's some really complex topics here, and you really want to be able to get some professional help and some guidance. There's a lot of software out there, but if you don't know how to manipulate it correctly, it might give you some bad answers. So we want to be looking at changes in taxes, looking at Social Security and when to be able to take this out, and when to take the distributions from your TSP or traditional IRA so you can either enjoy the money early or prepare for higher costs in the future. Hopefully today's video is very insightful for you and you got some really good information about what Medicare options are at age 65 and other healthcare plans that you may be able to look at. There's a lot of things you can be able to do, so please get professional guidance to be able to make sure you're making the best decisions. We want the best for you and your family, so please get conflict-free, unbiased advice. Thank you for your time today, and we look forward to helping you in the next video.